Hello, online. Hello.
Good evening, sir.
Yeah, good evening.
Good evening, sir.
All right, good evening, everyone. Please confirm that I can see my screen.
We can see your screen.
Okay. All right, good evening, everyone. In our last class, we started cost of capital, true, and we've been able to look at cost of equity, true or false. We look at two models that can be used to calculate cost of equity. What are those models again? DVM and what? What's the difference between the two? What's the difference between DVM and the capital asset pricing model? What's the difference? Huh? I didn't do it. What's the difference between the DVM approach and the DVM approach? Huh? The CAPM, yes. The risk is involved, yes. What kind of risk, sir? Systematic or systematic? Systematic risk, yes. Which other one? Which other difference? Dividend, yes, growth in where? In the DVM, yes. Any other one? Yeah. Okay, that's still under dividend. Okay, so basically we have ideas of what I'm saying. And then I gave assignment, I think. How many attempts? Okay, if you did not attempt, let me see your hand. I did not attempt it. Let me see. I was in class, I did not attempt. Let me see your hand. Okay, okay, tell us why you did not attempt. It's too simple, it won't come out. Okay, so why? Okay, I want to hear. Yes, tell us. That's why you did not do it. So what did you need that scientific calculation to do? Discount factor. Where else can you get discount factor? What? Raise to power. Hi. Your phone has the calculator. You want to do it, though. Let's not go there. Yeah, any other person? Who else did not attend? Yes, okay. Were you in class?
That was my best class. I'm trying to meet up with you.
Okay. So when are you attempting it, sir?
I got it. The next class, I'll be able to attend it.
Next class is when? So before two, it means you are doing it this night. Is that what you mean? All right, who else? Okay, you were in class. Did you attempt it? Yes. Okay, at the back, you did not attempt it. Yes, why? No time. No time. No time. Online. Etima. Nayam Sonia. Afolabi.
Good evening, sir.
Faith. Innocent.
Good evening, sir.
Did you attempt the assignment? Tell me.
Yeah. Yes, sir. Yes, sir. Yes, sir.
You're not too serious. I know you will never fail me now. I know. Pleasant. Pleasant Babalola. Did you attempt? Okay. All right. So remember when we started, we said WACC. Sorry. We have the equity part, is that? And then we have the what? The debt part. And the weighted average for WACC formula is KE multiplied by what? VE over VO, is that? Plus what? KD times what? VD over what? Over VO into what? 1 minus T. We did this. And I told us that this, actually, you can have as many classes of equity as possible. And also debt, you can have as many class of debt as possible. Another this debt, I remember in our last class, we talked about floating debt, right? We also talked about what? Redeemable, irredeemable, then convertible debt. Floating debt is simply just the interest rate, Abi. A debt that is trading debt is just the interest divided by the market price of that debt, is that not? And also we looked at redeemable debt. How do you calculate the cost of a redeemable debt? Internal rate of return of that bond, all right, of that debt, right? The convertible bond or debt, how do you calculate the cost? IRR, but what? But the final year, you compare what and what? Higher of conversion value and what? And the redemption value. And the redemption value. All right. So today, I need us to look at the live question 2018 question 1. All right. So I forwarded the Pathfinder 2014 till I think 2024 November diet to you. Where is that again? Yes, please. Yes. Irredeemable debt. So if the debt is not redeemable, it means it's just going to continue till the end. The interest you are paying divided by how much that debt is traded is the cost, right? Just like your trading debt also. So the interest divided by the market price of that debt, that gives you the what? The cost of the irredeemable debt. All right. So please, let's open to this 2018 question 1. November, please. November diet. So one very interesting question. I think it was adopted from ACCA. So, mm, 2018 May. All right. Please, can we open it on our device? So when I take this off, we can make reference to the question. But we'll read from here. We'll read it together, but just ensure you have it on your device. Online, please, can you see the board and the question? The question is on the group. Please open it. I think it's on page 349. Page 349. Please confirm that you're all there, online.
Yes, I'm there.
Yes, sir.
Okay. So please, somebody online, please help us to read. Let's read with understanding. All right. Read it with understanding, not like newspaper. Yes. All right. Please help us. Somebody online.
All right. Echo PLC. Echo is a listed company in food retailing sector and has large stores in all major cities in the country. Echo's board is considering diversifying by opening holiday travel shops in all of its stores. At a recent board meeting, okay.
Hold on. Echo's board is considering what, guys?
Diversifying.
Now, what are they into first?
They're into food retailing.
They're into food retailing sector, I mean. They are considering what? Diversification into what?
Holiday shop.
Travel shop.
What is going to change here? The risk is going to be changing. Am I correct? Which of the risk now? The business risk is going to be changing. All right, please go ahead.
Okay. At a recent board meeting, the directors discussed how the holiday travel shops projects should be appraised. the sales director insisted that ECO's current weighted average cost of capital, WACC, should be used to evaluate the project, as majority of its operations will still be in food retailing. The finance director disagreed because the existing cost of equity does not take into account the systematic risk of new projects. He said that the company's overall WACC, which reflects all the company's activities, will change as a result of the project acceptance. The board was also concerned about the market's reaction to its diversification plans. Another board meeting was scheduled at which ECO's advisors would be asked to make a presentation on the project. You work for ECO's advisors and have been asked to prepare information for the presentation. You have established the following. ECO intends to raise the capital required for the project. ECO intends to raise the capital required for the project in such a way as to leave its existing debt to equity ratio by market value unchanged following the diversification. Extracts from ECO's most recent management accounts are shown below. Statement of financial position as at May 31st, 2017. Ordinary share capital, 100 Kobo shares, 233 million. Retained earnings, as seen in the figure, 6% redeemable debentures at nominal value, redeemable 2021. Long-term bank loans, interest rate at 4%. Okay. Scroll down, sir.
Okay.
On May 31st, 2017, ECO's ordinary shares had a market value of 276 Kobo ex-div at an equity beta of 0.6 for the year ended May 31st, 2017. The dividend yield was 4.2% and the earnings per share was 25 Kobo. The return on the market is expected to be 8% per annum and the risk-free rate is 2% per annum. ECO's debentures have a market value of 108 x interest per 100 Naira nominal value on May 31st, 2017, and they are redeemable at par on May 31st, 2021. Companies operating solely in the holiday travel industry have an average equity beta of 1.40 and an average debt to equity ratio by market value of 3 to 5. It is estimated that if the project goes ahead, the overall equity beta of ECO will be made up to 90% food retailing and 10% holiday travel shops. Assume that the tax income rate will be 20% per annum for the foreseeable future. Required, ignoring the project, calculate the current WACC of ECO using the capital asset pricing model, CAPM, and the Gordon's growth model. B, use the CAPM to calculate the cost of equity that should be included in a WACC suitable for appraising the project and explain your reason. By calculating an overall equity beta and using the CAPM, estimate the overall WACC of ECO, assuming that the project goes ahead, and comment on the implications of a permanent change in the overall WACC. D, advise whether ECO should diversify its operations and how the stock market might react to the proposed project. E, identify the appropriate project appraisal methodology that should be used when a project's financing results in a major increase in a company's market gearing ratio, and using the data relating to ECO, calculate the project discount rates that should be used in these circumstances. Thank you.
Fantastic. Not to be saved. All right, 30 marks for doing nothing. Simple. All right, so let's take it one after the other. First, I would like to ask you, look at what the director said there. This director one, what did he say?
Hello, sir. Good evening.
Yes, good evening.
Sir, please, what year are we reading? I just joined.
2018 November diet. All right, so let's go into the question. Congratulations to those applying to JAPA. There's a signed MOU now between Ican and CPA, Abi. How many people heard that? Yes, it did. Okay. CPA and Ican, they have official MOU signed now. So if you're planning to JAPA to Canada, no, it's not automatic. But you're right, they are professional. Just, I think, few papers, like 3 or 4, we are not sure yet. But yeah, so which give you a very serious edge in case, but you have to be in Canada to be able to write. That's the only disadvantage. If not, I believe a lot of students from Nigeria will just start writing already. All right. So Ican November 2018, question 1. Name of the question is Eco PLC. What's the A? What are we asked to calculate? They say we should ignore the project first, Abi. All right. Calculation of the current weighted average cost of capital without the project. What will guide me here is that I know that WACC equals to KE times VE over VO. Is that? Plus KD times VD over VO into 1 minus T. Now, the sources of finance that we can see from this question, number 1, there's equity. Is that not, guys? Which other source of finance can we see? There's a debenture, right? And it's redeemable. So number 2, redeemable debt, and they call it debenture, right? So the debenture, what is the period? How long is it going to last? How many years? Now it's 2017, Abi, up to 2021, Abi, maturity. How many years? 4 years. 4 years up to maturity. Any other item? If you look at the long-term loans, are we there? How much is our long-term loans? 635, Abi. So we have 3 long-term loans, right? So these are the items we need. So it means that we're going to be having cost of equity, value of equity. We have cost of redeemable debt, value of redeemable debt, and then we'll be having cost of long-term loan, then value of long-term loan. Do you all agree? Yes. Okay, so let's start with the equity. Cost of equity. Now, what model can we use here? From the information given to us, what model do you think we should use? What model? Huh? Okay, they even told us to use CAPEM, Abi. Exactly. So KE, using what? Capital asset pricing what? Model. And according to that, KE equals to what? RF plus what? Beta into what? RM minus what? RF. What is the RF? Yes, from the question, what is it? Eh? How much? Where are you seeing that?
2%.
The risk-free rate is expected to be 2%, Abi.
Yes, sir.
Please, anybody having issues yet? Okay. What's the beta given to us? Their beta equity is how much? 0.6. 0.6.
Okay, 0.6.
So the RM is market return, Abi, which is how much? 8%. So can we get the KE? KE equals to what? 2% plus 0.6 into 8% minus what? 2%. Help me. Eh? Oh yeah, now figure. How much is it?
5.6%.
5.6%. Right? So let's get, now we have this guy already. We have KE. Is that? How can we get market value of equity? My market value of equity is simply the price per share multiplied by number of ordinary shares. Is that not? Now, market value of equity equals to market price per share multiplied by number of what? Number of shares. MPS is market price per what? Per share. And is that how much? MPS. What line did you see that? All right. 276 kobo. Now, the one you're seeing in the statement is nominal, right? Is the nominal value now of your shares, right? All right. So the one we have market price, they will expressly tell you the market price of their shares. And I think they gave us in paragraph. Okay. After the table, after the financial position, they gave us on 31st May 2017, a Coast ordinary share had a market value of how much? 276 kobo, right? So this is 276 kobo, which is same thing as 2.76 what? Naira. Are we all good? All right. So number of shares. $233 million naira divided by 0.1. Everyone, are we together? Okay. So 233 million divided by 0.1. So, and that should give me 2330. Is that? And so my market price, or market value rather, of equity will become what? 2.76 multiplied by 2330. How much? Help me.
6,431.
6431 million. Abi? We are done with this guy. Now the next guy here is what? Redeemable debt. Abi? Now we need to get the cost of a redeemable debt. And the cost of redeemable debt, we agreed that is going to be what? The IRR of that debt. Is that? So now let's get the parameters. So we are done with item 1 here. Item 2 is redeemable, Abi? Redeemable debt. The parameters, we have their market price now. Market price. What's the current market price of the redeemable debt? One is trading at 108, Abi? 108. Of course, our par value of this will definitely be how much? 100. Thank you. What's the coupon on it? 6%.
6%.
6%. Then we have a what's redemption? Redemption value. How are they redeeming it? At par, Abi? at par, which is how much? 100, Abby? 100. Tenor, we agreed that it's going to be how many years? 4 years. 4 years. I think we are done. So our KD here, cost of a redeemable debt equals to the what? Internal rate, Abby? Rate of return. So again, we have year 0. Is that? We have year. We have the cash flow. We have discount factor. And then we have the PV. Is that not? Can we remember? Yes. All right. So we have year 0, year 1, year 2, year 3, and then year 4. Year 0, my cash flow is usually what? The market price, Abby. Don't forget, usually market price. And that's how much? 108 outflow, right? So this is 1, and this automatically should be 108 outflow. Discount factor, preferably just start with your coupon, Abby. You can decide to choose anyone. So I'm using 6% here. So year 1. In the last question we treated, they asked us specifically to calculate the pre-tax cost of redeemable debt. Pre-tax means that you have not taken the tax out of it. But for the purpose of calculating weighted average cost of capital, what kind of cost do you use? Post-tax cost, Abby. So it means when you get out your coupon multiplied by the par value, you have to take out what? The tax effect out of it. So it means that our interest equals to, what's the coupon? 6% multiplied by how much? 100, Abby. Then multiply by 1 minus, what's the tax rate? 20%. So how much is this? 6 multiplied by 0.8 is how much? $4.8. Anybody struggling here? Okay.
Excuse me, sir.
Okay. All right. Now,
Please,
yeah.
I want to really understand this pre-tax, why we are multiplying it by 1 minus t. But in the previous question, we did not multiply it by 1 minus t.
In the question we did in class, the question, if you can open that question, and specifically they said calculate the pre-tax cost of debt for the following whatever. You look at that. Pre-tax means that, close your eyes from this. Abby, is that not what it means? But when you are calculating cost of capital, for the purpose of cost of capital, anytime you are calculating cost of debt, what do you deduct? You must take out the tax effect out of it. Now, let me explain the difference here. Look at this here. Can we see 1 minus t attached to this, right? What does this mean? This is only attached to debt, Abby. Why is it not attached to this one? This one doesn't attract any interest now, right? This one attracts what? Interest, you have to pay it out. So every time you are calculating your cost of debt for the purpose of work, it must be what? Post-tax cost of debt. When is a flat debt, like long-term loan? If my long-term loan, I take a loan from GT Bank and they say it's 7% or 10%. My cost of debt pre-tax is 7%. That's what the bank told me. Is that not? Post-tax will be 7% multiplied by 1 minus the tax rate. Do you understand that?
Sorry, where in the question we specifically say to read the tax?
Very good. They will not tell you. For the purpose of calculating weighted average cost of capital, it must be post-tax cost of debt. The only difference now is that when we are calculating here, because we have already deducted debt from calculating the debt, from the cost of debt, here, we now ignore this 1 minus t. I don't know if you get what I'm saying. Okay. Let me explain again. Calm down. We are looking at KD, Abi. You have long-term debt. Long-term debt amount is 200 million. Interest rate is 8%. Look at this now. What's the pre-tax? Pre-tax KD is how much? 8%. Post-tax KD will be how much? 8% multiplied by what? 1 minus 20%. Is that? So that we're having 8% multiplied by what? 0.8, and I'll have 6.4%, I think, right? Are we good? Now, if I'm calculating cost of debt, I mean, weighted average cost here, weighted average cost of capital. If I've done this already, it means I will have KE times VE over VO plus KD times VD over VO. That 1 minus T, there's no need again because I've taken it out. Are we together? So now, when you're doing it for a long-term debt, it's easy because even if you forget to do it from here, when you get to this, your WACC, you can bring it in. But when you are doing for a redeemable debt, because you have coupon over the years, it won't work. Right? Look at this now. We have our table set out this way. How many years? 4 years. It means year 1, there's interest. And interest is the coupon multiplied by the par value, 6%. But in that year 1, I need to take the effect of that tax from that year 1. So every year, as you're getting the coupon, in fact, before the money comes to you, they will have taken it. For those who have bond or debt instrument, the moment you make that amount, they take it even upfront every year. So because of the discounting factor, it means that you can't wait till you get the final IRR before you apply your tax effect. It's confusing. I just explained that the previous question. Can you open that question? Do you have a question? Can you read that? Let them. Yeah, the question was the question we did said calculate what? Current pre-tax cost of debt for the following. But if you are doing work, like I said, the question, your examiner will not tell you that you should calculate post-tax cost. They will not. Because it's assumed that for appraiser, the cost of capital to be used must be cost of capital after tax. The question we did in class was testing the microphone. Are we good now? Anybody still confused? Online, are you okay now?
Yes, sir.
Okay. Okay, so our year 1, how much are we going to have? 4.8, right? 4.8. Year 2, how much? 4.8. Year 3, 4.8. Year 4, 4.8 plus what? Plus how much? 100. And that should be how much? 104 point what? 8. Thank you. So discount factor at year 1, how much is it?
Mr. Chris.
Yes, ma'am.
Mr. Chris,
Yes, yes.
are we not going to go for the area of conversion value and redemption value in this case?
No.
Online, somebody tell me, when do we use higher of convertible?
Convertible debt.
This is not a convertible debt. This is a redeemable debt. Straightforward. Yes. Yes. No, at all. I explained how you can use annuity. In fact, the last class we demonstrated.
Because I noticed that the table that used to.
Yeah, you can use annuity. No, you can use annuity. Yeah. can try to use annuity, but when you are doing duration and all that, you may not be able to use that. You have to spread it out because you need to attach weight to all of them. So, but you can use annuity, still the same effect. No deduction of mark, nothing. In fact, when you start computer based now, you don't even need to do all this. You just do IRR equals to on your Excel, right? IRR equals to impute the market price, impute the interest rate, impute the year, and then your IRR will just automatically compute. Then you move on with it. At that point, Ican will not be testing this concept again. They are not testing you how to calculate IRR. All they're testing is to know whether you even understand how to calculate redeemable debt. That is IRR. That's all. And that's what it is currently doing. Okay, so year one, help me with the discount factor, please.
0.943. 943.
943, yes, year two.
0.890.
8,
90.
yes.
0.840.
All right, help me. How much? PV? .4. Yes. Yes. 0. 33. 83. No point, Abby. Okay. All right, help me out together. What do you have as my MPV? Eh? 95 points. No.
Minus 12.17.
Eh?
Minus 12.17.
17, Abby. All right.
Yes,
So
sir.
what do we have? What should we do now? Discount factor. Should we increase or we should reduce? We should reduce it, Abby.
Yes, we
What should we
reduce
do,
it.
sir? Should we reduce the discount factor or increase it?
To reduce to get a positive value.
You also understand that when you're discounting, it's like a cost. The higher your discount factor, the lower the MPV. It's like cost now, the same way you have your cost. So the reason why you're having negative is probably because this cost is too high. So how do you turn this to negative? You need to now reduce the cost, right? So now we should reduce it. Let's use 2, Abby, 2%, just to be safe. This is still 1. My PV here is still 108 outflow. So help me here, 1, 2%, 0 point. Are you sure? 98, yes, figure.
980.
0 point.
980. The first one.
Okay, 961. Yes. 0.942. Yes.
0.92334. 0.924.
0.924.
924.
1. Say again. 4.70. .61, yes. 4.52, yes. 96.8384. Help me.
2.67.
2.67. Positive, Abby? All right.
Yes, sir.
So our KD equals to IRR, Abby, which equals to what? Lower rate plus what? MPV lower rate over MPV lower rate plus MPV higher rate minus lower rate. Sharp. What do we have? Our lower rate is how much? 2%.
2.67.
Plus MPV of lower rate, 2.67. Divide 2.67 plus 12.17 multiply 6% minus what? 2%, sorry. All right, help me. If you have a good calculator, what do we have? So this is 2% plus whatever thing you have in this box, then multiply by 4%. Help me. 2.67 divided by
2.72.
everything.
2.72.
Okay, everything. Thank you. 2.7.
Oh.
2.72%. That's higher.
That's the final answer.
Final answer.
2.72.
2.7%. Quite low. Okay. All right. Okay, so I think we are done with this guy, right? So now we have cost of redeemable debt. We need to get which other thing again? Value, Abi? The value of redeemable debt. Is that not? Value of redeemable debt. Right? We have the trading value, market value of this redeemable debt is how much? 108, Abi? 108. And the par value is how much? 100, Abi? Book value is how much? From the balance sheet, how much is the book value of the redeemable debt?
1,900. 1,900.
1,900, Abi? So our market value of redeemable debt equals to 108 par value multiplied by 1,900 in million. How much do we have? Eh? 2052, like this. All right. Anybody having issues? Anybody having issues? Any problems? Okay. So if your bond or your debt is trading at par means that the par value is same thing as the trading value. It means the book value is same thing as the value that you have, as the market value. Is that not? In that case, we are having 100 over 100 multiplied by 1,900. But every time your bond or your debt is trading at a premium above the par value, it means that the book value, of course, has to be adjusted upward to reflect the market value, because this is how much the book value of the redeemable debt is. Right? The par value, which is how much I booked that debt, is 100. But currently, the debt is now trading at 108. Should the value be higher? Market value be higher or lower? Should be higher. So that means I have to do 108 for this. That's like it's trading like 8% premium, something like that, right? So that's 108 divided by this, multiplied by this. If it's trading at a discount, let's say 96, what should I be doing? I will do 96 divided by 100 multiplied by this. It means the book value is already higher than the market value. So this value would have reduced. Do you understand? Okay.
No, sir. No, sir.
Yes.
Please come again. Don't understand.
Okay. What does this mean? Trading at a premium. Is that not what it means?
Okay.
Meaning that this is the book value that I have. If you look at your balance sheet, is it not that much you are carrying this debt? But the market value of this debt, is it 19? No, now, because if I want to dispose this book, this debt now, at how much am I going to be disposing it? At 108, Nabi. 108. So it means if I want to bring it up, I need to do 108 over 100 multiplied by what? 1,900. That's what will give you the market value. If this debt were to be trading at a discount, it means that this amount will have been lower than maybe 100, maybe 96 or 85 as the case may be. In that case, the market value of this debt will have been 98 or 80 something divided by what? 100 multiplied by that book value. If it's trading at par, what would I do? What would I have done here? 100 over 100 multiplied by 19. In that case, it means the market value is same thing as what? The book value of that debt. Are we together? All right.
Yes, sir.
So we are done with this redeemable debt. The third kind of loan we have is a long-term loan. Is that? So item 3 is long-term loan. Long-term loan is usually not trading. All you are just doing, what is the interest on that loan and how much was the book value. Since it's not trading, the book value is automatically the same thing as what? As the market value. Are we together? So here, cost of debt for long-term loan is the interest. Interest net of what? Tax, remember? Right? From this, what is the interest rate? Interest
4%.
rate equals to 4%. Abi? So what will be the KD here? I'll just simply do 4% multiplied by what? 1 minus what? 20%. Abi? How much would this give me? 3.2%. So this is the cost of debt for long term. And then the market value equals to the book value. Why? Because the debt is not trading. So what is the book value? Book value equals to market value and equals to how much? 35 million. We are done with this question. 8 marks for doing nothing. For doing nothing. For doing nothing. Adia, is it doing Wawa yet? Not yet. All right. So now, let's quickly bring them together. So our work formula, remember, it will now be something like this. KE, Abi, multiplied by VE over VO plus cost of what? Redeemable debt. Abi, multiplied by value of redeemable debt over VO. Okay? Plus cost of long-term debt multiplied by value of long-term debt over VO. Remember, we have applied tax to this debt already. So there's no need, right, to apply that here. Which one? For this guy? Eh? See now, the interest on this long-term loan is 4%. We have taken out the tax effect. This is the cost of debt, post-tax cost of debt, right? Okay. What's VO? Thank you. Value of the organization, right? Remember when we started, I drew one balance sheet for us, Abi. Finance value equals to the total asset, Abi. Yes, we can do that also. Anyone. If you have convertible debt in this question, I will have said plus cost of what? Convertible debt multiplied by value of convertible debt over what? Over VO. It can continue and continue and continue. Right?
So you say VO is what?
VO is the value of the organization, which is the combination of VE, value of this, like a weighted average now. Value of this plus value of this plus value of this. They are market values, which we have calculated already. We add all of them together, and that's what will be down here, which is the VO.
So, preference share. Preference share.
Yes. Value of preference shares. Now, you have cost of preference shares multiplied by the value of preference shares divided by VO. It will come here. But it doesn't have tax effect because it's in this family. Right? Which one? Book value. I've explained this now because it's not trading. The book value, if you take a loan from GT now, if you want to sell back that loan, it's the same amount you're selling is Abi, because it's not trading. But if your loan is trading in the market, right? You can make a loss or make a gain on it because it's trading. So the value, market price of that loan or debt or bond can increase or decrease. Abi? Yes. Anytime you see a debt and they say trading at or the current market price is, it means it's already trading, Abi. It means that debt is quoted, it's debt, right? Eh? Is it time now? Okay. All right, can we go for prayers and then we're back? While we wait for them, if you have any questions, clarification, please shoot while we wait for them. Any question? SFM only. Thank you. Right. Yes. Exactly, to be able to fix them into this formula. Yes. Taking them exactly from the question. From the question. And it will be obvious to you. You see the one that relates to cost of equity. You see debt also. Just start bringing them out. The reason why I wrote this formula first is so that you know what you are looking for in the question. KE. Yes. So this KD, I thought it was just two until we read, and we now saw that, oh, there's a long-term debt also. Again, we have to now calculate cost of long-term debt and the value of long-term debt. When you're done,
we have
three. There are three now. Look at. Yeah, you have two because you have the redeemable one and then the long-term one. Yes, that's why you have two.
So please, can you scroll up? Let's copy.
To where? Where?
To the beginning of the solution.
Ah.
I wasn't copying before.
Okay. Yes, the CAPEM. The question asks us, look at the question. Sorry, don't worry. We use CAPEM already now, even. Abi? Cost of equity, that's the first thing we use now.
It's CAPEM we're working on, the first one.
It's CAPEM we did now. Look at it
We
here.
we just did. It's CAPEM we broke down.
That's the first thing we did.
So, sir, are we still on the campaign?
KE, yes. Yeah, that's the equity part. The question will give you dividend. It means you now have to use DVL in place of this capital.
Now please scroll up. Please scroll up, sir. Sir, come down a bit. Yes, thank you. Now scroll down, please.
Well,
Yes.
relationship between yeah, okay, yeah. If inverse. If your coupon, the discount factor you're using is going up, your NPV will reduce because the discount factor is like costly. Right. It is going up, NPV will reduce.
Excuse me, sir.
Yes.
I have a question.
Yes. Go ahead.
In a situation where we are not given the market price per share and we are asked to find the value of equity, please, how do we find it?
They must give it to you. They must give it to you. Market price is either they give you in whole or they give it to you as per share. In extreme cases where you don't see it, which I believe it will never happen, you use the nominal because you don't have any choice, of course. But it's not possible. You just pick it from the balance sheet the way you see it. But it's like I said, it's not possible. Show you Inugo.
Just scroll up, please. Please scroll down. Go down a bit more. Copy it up to markets. Yeah. Just like scroll up a bit. I mean, I've copied all this, please. Yeah, thank you.
Yes. Are we back?
So scroll up, please.
LD.
Long time there. You can give it any name you want. It doesn't matter. Yes. Can we continue?
Yes.
All right, so let's quickly get our WACC. WACC equals, so what's our cost of equity calculated? A is how much? 5.6%. 5.6% multiplied by what's the value of equity? Okay, so before then, let's get our VO. I don't think we have calculated VO. VO is just to add all the market values together. So let me quickly do that somewhere. And take this off. So the first one, we have market value of equity, Abi. Market value of equity. Next one, market value of what? Redeemable debt, Abi. And then market value of what? Long-term loan. All right, equity, how much is it? All figures in million. 6431. Redeemable debt, how much? 2052. Long-term debt, 635. So our VO, value of organization, how much? 9118, like this. Okay, so let's go here now. Our WACC equals to KE, you said is 5.6%, multiplied by what's the value of equity? Calculated, where is it? Okay, 6431, Abi. So we have multiplied by 6431 divided by what? 9118. 9118. Plus, the next one is cost of redeemable debt. We got that already, 2.72%. 2.72% multiplied by what's the value? 2052 divided by 9118, right? Plus, is it 3.2? Yes, 3.2% multiplied by 635 divided by what? 9118. And we are done. Help me. How many percent? WACC is what? 4.78%. And we are done. You may decide to do tabular method. If you want to use the tabular method, approach, I will have sources, I have cost, I have market value, and then I have average. And this average is simply the cost multiplied by the market value. Abi? The source, I have equity. Next one is what? Redeemable, Abi? Redeemable debt. And then long-term, Abi? Long-term debt. The cost, equity, 5.6%. Is that? Redeemable debt, 2.72%. And this guy is a 3.2%. Their market values, same thing as what we have here, 6, 4, 3, 1, 2, 0, 5, 2, Abby, and then 6, 3, 5. The total is 9118, Abby. The average is simply multiplying this guy by this guy. Abby, help me multiply. What do you have for equity? 5.6% of 6431 is how much? Eh?
3601.
360. 360.16. 0.16. Yes, this guy. Eh?
5581.
This one is 0.14. Like this, okay. And this guy?
5581.44.
Eh?
5581.44.
558.
81.
Eh? 55.81. 55.81. Okay. 20.32. All right. Total here. Percent to 43.27, Abby. So WACC equals to average divided by the market value multiplied by 100 over 1. What's the average? 436.27. Market value 9118. Multiply 100 over 1. Help me. 4.78%. So whichever approach you want to use, all the same, you'll be good. All right. So that's that about the part of the question. Any question, please? Yes. Yes. As simple as anything. Now let's look at the B part. What's the B asking us to do? Gordon's guy, Abby? Is it? Okay. B. Calculation of work using Gordon's model. Gordon's model is a method under which of the component of cost of capital? DVM, Abby, which is under equity. What it means that my cost of debt is going to remain the same. It means the value of preference, the redeemable and those long, whatever thing we have done is the same thing. Except that we are going to now be changing what? The equity part of this. And then we'll do the same thing. No thinking. So let's quickly look at that. AII. Oh yeah, sorry. No verse. I was testing you. AII. All right. So, and according to Gordon's, so first our KE equals to D0 into 1 plus what? G divided by what? MPS plus what? Plus G. Abi? Where D0 is dividend when? Now G equals to what? Growth rate. And now they say we should use what? Using Gordon's model. And then MPS is what? Market price per what? Per share XT. Don't forget. All right. And then, of course, our K is cost of equity. All right. So, and according to Gordon's, G equals to R multiplied by what? B. Where what? R equals to what? Return
Return on
on what?
investment.
On
Investment.
equity. And B is what?
1 minus
Retention.
retention ratio.
Retention ratio. My return on equity equals to profit attributable to ordinary shareholders divided by what? Opening equity, Abi? Opening equity, right? Yes, multiply by 100 all over 1. I told you, if your time is not enough, you don't have to bother yourself. But your examiner, which method do they prefer? Opening, right? So for class purpose, we are using opening. You can decide to use opening also if you have time. If you don't have time in the exam, what do? Just go to your balance sheet and pick what? The equity and put it here. Then move on. You get your full mark, right? At least for now, that's what your examiner said. So, but this is preferable. Yes? Profit attributable to ordinary shareholders. Right. Okay, so now let's go into the question. Which of these parameters do we have? Do we have dividend? Do we have growth? Do we have MPS? I think MPS is given already, I think. Go there to where they gave us information about Are we there? Yeah. We have MPS already. What's our MPS? MPS is how much? 276 kobo, Abi. And that's the same thing as how much? 2 point what? 76 naira. Now, what do we have from this question? If you look at this very well, they didn't give us profit statement, profitability statement. We don't have it, Abi. But they gave us EPS, Abi. Go to the question. They gave us EPS. EPS equals to what? 25 kobo is same thing as 0.25, Abi. And I have number of shares. Okay? Number of shares, we go 2330, Abi. Shares. We agreed. And I know that EPS is what? Earnings per what? Per share, Abi. And then EPS is profit after tax divided by what? Number of shares. People of God, can I get profit after tax here? Right? So my EPS is 0.25 equals to profit after tax divided by what? 2330. I've converted this to simple mathematics, no longer SFL. And profit after tax equals to what you tell me, 0.25 multiply 2330. Help me. 582 point what? 0.5. That's the first. Again, we don't have anything about dividend though. Abi? They gave us dividend yield instead. That means I need to understand the relationship between dividend and dividend yield. Anytime you hear the word yield, all they are just saying is like inverse. Now, let me give you one small thing that you don't have to cram. Look at, can you remember P ratio? P ratio is price to earnings, right? PE, that's ratio of price. The price they're referring to is market price. Abi? Ratio of market price to earnings. That's what they are saying. That's why it's P ratio. And this formula from this name means that it's MPS divided by EPS. This is the formula. Abi? because it's the ratio of price to earnings. That's why it's called PE ratio. If the question now says, what is the yield? Earnings yield. It means that is the inverse of this guy. So my earnings yield, EY, equals to EPS over what? MPS. The same thing is applicable to dividend. Also, if I say dividend price to earnings, the same thing as MPS divided by DPS. If you hear yield, dividend yield, is simply what? The inverse now is that not, it's not the same thing. This is price to earnings, market price per share to earnings. The yield is the inverse, which take this one up, bring this one down. The price of your dividend price to earnings, is the price, just like this one also, by what? DPS. If I'm going to the yield also, is the inverse of this guy. So my DY, dividend yield, becomes DPS over what? MPS. So it simply means that if I have dividend yield and I have my market price per share, can I get my dividend per share? By doing what? Cross multiplying. Exactly. That's where we are going to. So in this question, let's quickly get our dividend. So dividend yield, NB, since dividend is not given, we use the relationship between dividend yield and what? And the market price, Abi? Market price to determine the dividend. So my dividend yield equals to what? Inverse, Abi? Dividend per share divided by what? MPS, Abi? So my dividend per share equals to dividend yield multiplied by what? Market price per share. Dividend yield is how many percent they give me? Okay, so DPS, let me write, equals to dividend per share. DY is what? Dividend yield, Abi. And then MPS is what? Market price per share. Am I too fast? Is the pace okay? Let me know when you think I'm too slow or I'm too fast. Okay. All right. So my DY, DPS here is unknown. DY, you told me now that is 4.2%. Okay? And MPS already 2.76. So that my DY, which is 4.2, Abi, 4.2% equals to DPS over 2.76. Okay? So that my dividend per share equals to 4.2% times what? 2.76. Help me. Here go, 0.120. So this is my dividend. Dividend per share, okay? If I want to know the total dividend that was paid out, can I know it? By multiplying what? By what? By 2330 to give me the total amount that I paid out. Abi? So total dividend paid, Abi, equals to dividend per share multiplied by what? Number of shares. Unasabi book. And so I have 0.120 multiplied 2330. Help me. 272. 270, sorry. Hey, why meaning? Eh?
279.6, Abi.
Okay, so let's approximate.
Okay.
Now we have seen the total dividend that they paid out. True or false? And also we have seen their profit after tax. Am I correct? Can we get their retention? Can we get their payout? What's their payout ratio? What is the payout ratio? Payout. This is how much they paid now. Out of how much? Out of this, their profit now. Look at their profit. This is the total profit they have made, Abi. And the total dividend is how much? This amount. It means they have paid 280 out of how much? Exactly. That will give me my payout ratio. Am I correct? To get my retention ratio will be 1 minus what? Minus the payout ratio. Are we all good? Is there a problem? You sure? All right. So profit after tax, recall, profit after tax equals to 5 what again?
582.4.
582 point what? 5 Abi. Dividend paid. I paid 280. 280 Abi. So payout ratio equals to 280 divide 582.5 times 100 over 1 year. Help me, how many percent? 48.1%, right? So my retention ratio equals to 1 minus payout ratio. And that should be what? 1 minus 48.1%. If you have a good calculator, help me. 0.52. That means my retention ratio is how many percent? 52%. We are done with one part of our Gordons. What is the second part? Return on capital, return on equity. Is that not? Okay, so let's get our return on equity. We said our return on equity, R, equals to what? Profit attributable to ordinary shareholders divided by what, guys? Opening, Abi? Opening equity. So we already have our profit after tax. The only thing is to get our opening equity. How do we get opening equity? Retain earnings, you take retain earnings for the period out of what? Closing. What's the closing equity, guys? From the question. Do we have it? How much is it? Kilo day?
It's 5,260. Oh.
What is the formula? You are overthinking this thing. What is the formula? What is the formula in the return? How to get R? What is the formula? Pathos divided by what? Opening equity, Abi? Is this a component of equity? Yes. Is this a component of equity? Yes. Exactly. So if you have premium, you have all these go to go. Are they all equity? Yes. Yes. Revaluation reserve, all of them, if it's in equity, it is part of equity. What am I picking here, guys? 5260. Abi? All right. So how do I get the opening? So my closing equity. So opening equity equals to what? Closing equity minus what? Retain earnings for the period now. Okay. I know you are testing us, but it's fine. Retain earnings for the period. Okay. Abi? All right. So our closing equity, you told me, is how much? 5 what? 5 what?
5823.
Minus. What is the retained earnings for the period? Somebody help me for a bottle of Coke.
5030.
Thank you. Of what? Of that profit, Abi? Thank you. That's what I'm retaining now. Or you can decide to just take this amount out of your profit after tax now to get what you are retaining. Is there a problem? You're good? Okay. So which method are we using? Which one do you want us to use? Retain earnings. I have 582.5 minus 280. Abi, how much is it? 30.5. This is how much I'm retaining. 302.5. So minus 302.5. Help me. Figure. Say again. 4960.5. Okay. Now that we have this guy, we can calculate our R now. R equals to, what's the pathos? 582 point what? 5, Abi? 582 point what? 5 divided by what? 4960.5 times what? 100 over 1. Help me. How many percent?
$11.74.
11.74%. Like I said, if you don't have enough time to do all this one, you just put this guy here. Abi, did I say that already? And then just drop a comment for the examiner. Even though the opening equity is prepared, but because of time, closing equity is used here. You are just going to tell him now. Abi, you don't know there are plenty of assumptions there in SFL. Yes, now. Yes, now, yeah. But because of time, closing equity is used here. Your examiner, what they are testing is the knowledge, Abi. And you have told the examiner that I know how to do it, but I don't have that time. Now, because if you check their pathfinder also, they will tell you that although opening is preferred, however, students may decide to use closing. But for your future exam, you may want to use opening. Go and check. Yes, now see it from the balance sheet. And all you just write, just how many seconds? Just drop a line for him. You are good. Move. No time. All right. So we have our G here equals to R times what? B. We have these parameters already. G equals 11.74. Percent multiply B is how much? 52%. Up here? Help me. How much? Figure. 3.1%. I've gotten my growth. Abi? And I have my dividend already. And I have my market price already. So So my KE now becomes what? Remember D0, 1 plus G into what? MPS, Abi, plus what? Plus G. I'm done. What's the dividend I calculated that time? Abi, see it here. 0.120. 0.120 into 1 plus 6.1%. Divide MPS 2.76. Then plus what? 6.1. Nasabi book. Help me if you have a good calculator. Oguchala. Yes. Figure. I'm calm. Eh? Dividend, yes. Dividend. Yeah. You can decide to do total. I told us in last class. You can decide to say this is my total dividend, Abi. If you are doing total, it means this also has to be what? The market capitalization, the total market price, Abi. So anyone. So now it's per share. Per share, exactly. Because this FPS is per share, market price per share. So you can decide to use the total. The same answer, same effect. How do we calculate dividend? Why? Eh? Which one? Yes, DPS. We use that yield now. This 280. That's what we use for the retention now. Yeah.
10.7, sir. 10.7%.
Also, if you take your DPS out of your EPS, you can do that also. You know, we did total here for this retention. You can also use per share, but it's still the same, actually. So, how much? 10.71%, Abi. So we have our KE. Our market value is not changing. Market value is still the same. How much? What's that market value from A? Eh? 6, 4, 3, 1. Kilode. What happened? Let me know when I'm talking to myself. Oh. Have I started talking to myself yet? Have I started talking to myself yet?
Sir.
Let me know. Ajia, anybody thinking of dropping SFM at this stage? Nobody, please. And this guy will be so cheap.
Yes.
I'm telling you, very cheap. Don't try to drop it. If not, you will regret. But I know nobody will drop it in this one. Just face it. They just changed syllabus now, so it's expected that it will be soft. But the good thing is, even if SFM is soft, you get it. You don't know it. That's the problem. But all that you need is all these small concepts. Just bring them together, and you're good to go. Honestly. Eh? Yes, Ned. Oh, yeah. So, our work is same thing. What is going to change? Are we using the table format or the statement format? Which one? Should we use table? Okay. So our work, anyone you want to use is fine, equals to our KE is 10. I don't need to write the formula again. We have grown past that. So I have 10.71% multiplied by 6,431 over. No, it's not. It's going to change. Okay, it's still the same. Yeah. 9,118, Abi. Plus the other guy is how much again? Redeemable. Eh? 2.7672% multiplied by what was the value? 20 divide 9,118 plus the last guy is the 3.2%. multiply, the value was 635 divide 9118. Opari. And then I get my work. Help me, final figure, if you can, help me. Online figure. Figure? Anybody? Oh yeah, 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 oh yeah. Eh? Final. 8 point. So can we do 8.4%? We're done. Questions, please. Any questions? What's the B part? Exactly. What are they trying to say here? The first one we calculated, they said we should ignore the diversification of that project. That means we are just using the existing position of the company. Now, the B part is now saying, assuming that they are going to be diversifying, what are we doing? You are going to be considering what? The risk of what? Of the new business. Is that? So now they gave us a project. But before we go into that, let me just introduce us to that. Remember, now remember in this question, look at what this guy is saying. The original place where they got this question from, the A part of the question asks them to justify these two directors' positions. Look at the director. What's the director one saying? Where is that? Now look at the first. See this guy. The finance director, no, the first one. Okay, yeah. The sales director insisted that current weighted average cost of capital should be what? Should be used for the project, right? Of its operation as project, as majority of its operation will still be in food retailing. The finance director disagreed. Any problem?
Please go on, sir.
The finance director disagreed because the existing cost of equity does not take into account the systematic risk of the new project. He said that the company overall work, which reflects blah, 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 activity would ask to change as a result of the new project. Who are you supporting? The question, like I said, the ACC question, when they took this from, they said, comment on the position of the two directors. What would you say? Who are you supporting? Let me ask. Why? So you're saying that the existing cost of capital can no longer hold, Abi? Exactly. So every time you try to change your business type significantly, what happens? So that's what I'm asking you. So what do you think? Okay, why? With so even if it's 1%, if majority is still going to be in food business, let's say that the risk profile in that business is let's say 0.1, meaning that it's significantly lower than the market is studied. And then when you're going into is now 0.9, which makes the total risk study. What happens? Automatically, it means that this new business is actually higher. The risk is so much. Let's even say the risk factor is like 1.8, which is very, very risky. I mean, riskier than the market risk, right? By the time you add it to this food, automatically your existing work can no longer be correct, right? And so the position of the finance director is actually what? Is actually better. Why? Because when you try to change your business type, one risk that happens is what? Is your business risk. And so you now need to adjust your what? Your cost of capital. And that cost of capital you adjust is only coming from which side? Is it the debt side or the equity side? Debt? Is it debt side or equity? When you change your business type, the risk, is it coming from equity or equity side?
Equity.
It's coming from the equity side because of what? That systematic risk that you have in your capital asset pricing model. And now the system, the examiner, they even make it easy. Look at it. They said, let me show you one salient point here. Look at ECO intends to do what? Raise capital required for the project in such a way as to leave what? Existing debt to equity ratio. All they are saying is that the gearing is unaltered. Because the moment your gearing is altered, something happens because of equity. And so that means additional to the risk of the business, there's also a pressure from the expectation of who? Of the investors. And so now the director, they are telling you in this question that forget about the fact that gearing is going to change. They have said that they are going to make sure that the gearing ratio is going to remain the same so that there won't be an impact or pressure from investors. So the only thing you're facing is the fact that the risk of that new business is what? Is changing, which is going to affect our what? Our cost of equity. Right? Now, that brings us to project-specific cost of capital. Now, when you say project-specific cost of capital, we are simply referring to that cost of capital that reflects the risk of that new business you're doing. Abi, is that not? Now, here, and the only thing we are looking at here is just from this CAPM, right? KE equals to RF plus beta equity into what? RM minus RF. Is that? Now, I explained to us that this guy here is the major issue. Major issue when it comes to project-specific costs. How is it a major issue? Because this guy can be a better equity and it can be what? Better asset. It's a better equity when it has both what? Business risk and what?
Financial
And
risk.
financial risk.
risk.
And this guy is only what?
Business risk.
And I told us in last class, for a business that does not have debt, the cost of equity of ungeared equals to RF plus better what? Assets. Abi? Into RM minus RF. For a business that has debt, this will be cost of equity of geared equals to RM plus better equity. Abi? Into RM minus RF. So what is actually changing the cost here is what? This risk, this VE. In this question, are they geared? Is it a geared company, the Eco PLC, from what you can see? Are they geared? Yes. How do you know they are geared? It means that from time I know that this, what I should have here at the end should be better asset or better equity. Better equity. If I know that this should be better equity, the next thing is the business they are going into. Do I have their risk factor? Most times in the exam, they will give you what you call a proxy, right? A proxy is simply saying a company that is already operating in that line of business where you're going to, because you are new there, you don't have a better, because better is only quoted in the market. Because you are new, it means you can't have a better that is quoted. The only thing you can do is to go to the market and get a company that is already in your line of business and you pick the better risk, the risk factor there, and then use it to appraise your project. Is that? Now, when you get to that market, you go there and then I say, oh, Bratton PLC is already into that business that you are doing. Bratton is on equity finance. It means that the better of Bratton that is posted or that is quoted in the market, is it better equity or better asset? Yes. Because they told me now that Bratton is what? All equity finance. Please follow me now. If I get to the market and they say, oh, there's a better equity for somebody who's already into this business, and this company has both debt and financial risk. I mean, financial risk and business risk, right? It's a geared company. It means the better that is given to you. Is it a better equity or a better asset? Better equity. Why? Because the company has two advantages. What do you need from that company? You need only one thing. What do you need? The risk that relates to only the business. Because I told us that financial risk depends on policy, depends on your risk appetite, depends on the nature, depends on the policy statement of the board of directors. Some will say, look, we don't want debt at all. Regardless, like these guys now, they are saying, no matter what you are going to do, we make sure that the gearing level remains the same. That is what they are saying. So now when you get to the market and you are now seeing a company that is quoted that has both business risk and financial risk, one thing I should do first is to be able to separate their financial risk from that better, so that the only thing I need is the better asset, which is the risk that relates to the nature of the business they are doing, because that's all I need. And I told us in last class that if two companies are into the same business, you're selling water and I'm selling water, we are faced with the same risk. Ordinarily, we have the same EBIT. But most times it's not like that. Why? Because you may decide to use 30-70 and I'm using 60-40. Meaning that the moment your capital structure is diluted, we can't have the same business with the same profit again. And so what we are doing is the moment you get to that market and you see that it is better equity, we need to remove the financial risk of that company, that proxy company. From that, they are better. So that what I will be having left will be what? Better asset. The process of removing that their financial risk from that total better is what we call gearing, or what they call ungearing. Very simple, but don't worry. In our next class, we'll take it on from here and then we'll use that to complete this question, and then we'll see how we can take it off a notch higher. Thank you guys for listening and see you again. Tomorrow, I may not be available. Mr. Asa will be coming tomorrow for your class, 8 a.m. Please, just the same energy, the same cooperation, please. I'll see you again when I see you. Enjoy the rest of your evening and good night. Yes. Say again? No. You will start and you do something else. So there can be a flow. Yes, question? Note. Yes, you get the note now. No problem. Online, are we good?
Yes, sir.
All right. Good
Yes,
night, everyone.
thank you,
Bye-bye.
good night.
Yes.
Thanks, sir. Bye.
Yes. It depends, but most likely, yes. Most likely, yes. But just be around. Be around.